So friends, when we just talk about the derivative accounting, there is something which is very crucial, and all of us, particularly in the today's scenario when we all have experienced the recent debacle with respect to IndusInd Bank, wherein approximately 2,000 crore of the discrepancy in derivative accounting was observed. Just look at the one issue where the company has been complying with the best of the practices for IFRS Ind AS. They have been doing the wonderful transparency and financial reporting. However, one small issue which has become very large, the huge impact on the brand of the company, reduction in share prices. So that's why it is very crucial and critical for all of us to have the brief understanding about the derivative accounting. So in today's topic, I'm going to discuss about the derivative, the basics idea about overview of derivative accounting for Ind AS 109. We'll also talk and touch about the what happens in Indus Bank and how the accounting standard is different compared to Ind AS. The derivative has been taken as one of the most important risk management tool by a lot of corporates. Why is this risk management? Because in today's world, a lot of financial products have been embraced by the corporates. For example, it can be interest rate swap, it can be with respect to hedging the foreign exchange risk, or there can be index related the instrument which have been issued by the corporates. So in this scenario, how to do accounting of this derivative has become very difficult. If we just look at overall in global, in world, IFRS 9 talks about accounting for financial instruments. In India, for large corporates, it is Ind AS 109, which is like relevant to IFRS 9 of IFRS. In USA, which is again one of the very, very important dominant gap in the world, it is ASC 815. ASC stands for Accounting Standards Codification. So in USA, the US GAAP is primarily has been formulated as part of ASC is concerned. So ASC 815 is again in line with Ind AS. However, in US GAAP, it is much more detailed, very much detailed guidance is provided under US GAAP. So this is overall, if you just look at how everything is aligned with the IFRS 9, and that's why today when we talk about Ind AS 109, we are also discussing about the IFRS 9. Now let us understand the today's agenda. We are going to cover first about introduction to derivative. What is derivative? Because the word itself is so complex for all of us that whenever it comes to picture derivative, we feel it's very, very difficult to digest. So, however, if we just try to understand concept, it's not so complex, but how it has been made complex because of the lot of complexity involved into today's financial world. Second, we are going to discuss about the applicability of Ind AS 109 as far as derivative contracts is concerned. When we talk about derivative, I think the second very important thing is to also discuss about hedge accounting, because the primary purpose of derivative has been generally to hedge. Whether it qualifies for hedge or not is a different story altogether. However, the hedge accounting and derivative accounting, they both need to discuss together. Then comes about the comparison Ind AS 109 with accounting standards. And lastly, we'll also talk about the story so far which is available in media as far as the IndusInd Bank is concerned on derivative accounting discrepancy is concerned. Let us first, friends, begin with what is derivative. Derivative is a financial contract or instrument, or it is a contract which is having three characteristics. I think whenever we talk about the derivative, I think the most important thing is that the word derivative means derived. I will just try to understand that this is where derivative is divided to derive, D-R-I-V-E, derive, and then ATV is again adjective which comes together as derivative. So there are three main important characteristics of derivative. First, it's a value changes. So when I just use the word derive, I think it talks about the value changes. Its value is derived based on the value of something else. So it is derivative value changes, or the value is derived based on the change in the value of underlying. So there are a few concepts which we have to understand the word underlying, uh, to which this particular contract has been annexed or mapped. That is the first characteristic of derivatives concerned. Second very important thing is that it requires no or very less initial net investment. I think one of the most important thing which we will understand is the word is initial investment. In general, whenever we enter into contract, initial investment is a mediocre or large amount. However, whenever you enter into derivative contract, initially there is no investment is to be made, or even though investment is to be made, the amount is very small. So that is one of the second important characteristics of derivative. Third very important thing is that it is settled at a future date. So these are the three important things which are there in always in all derivatives. So first and foremost, when you just talk about derivative accounting, the first question is that is it a derivative? Because every contract may not be derivative. Now, whether that contract is a derivative, for that we have to look at these three characteristics. If a contract is derivative, then we need to look at Ind AS 09. If it is non-derivative, then the accounting is gone by again different parameters. And third very important aspect is about the is it a hybrid contract or not. So these are the three very important questions which are coming to mind when you talk about the derivative accounting. Now, for every accounting, the standard provides you guidance of initial measurement and subsequent measurement. If you open any of the standard of India's, whether it's India's 16 pp or it is about the India's 38 or India's 40, but every standard has certain principles on initial measurement and second is a subsequent measurement. The word initial recognition measurement is means at the time of transaction, where the date on which a transaction happens, at that time when to recognize and at what value it is to be measured. That is initial recognition measurement. Subsequent measurement is talking about how to measure at each reporting date. Now, reporting date can be quarterly or half yearly, or it can be year end. It's based on how the company is providing their financial statements. Initial recognition measurement is always at fair value. All the transactions which are here, they need to be initially recognized and measured at a fair value. And the classified and measured in subsequent case at FPTPL, unless qualify for hedge accounting. I'll just little bit pause here to give you a little bit recap of the understanding of this classification and measurement requirement. Under Ind AS 1019, the financial assets need to be classified and measured at that amortized cost or FVTPL or FVTOCI. Obviously, there are few more options available regarding FVT OCI with recycling and without recycling. So, in general, the derivative is measured at FVTPL unless qualify for hedge accounting. So, when we talk about the hedge accounting, we'll discuss that how these both are relevant. Even though there are hedge accounting is always discussed along with derivative accounting, but they both are completely different accounting. Probably a derivative contract is to be accounted as per these particular requirements, but it may not be qualifying hedge. How it qualifies for a hedge, then we need to look at the conditions and criteria, how it is classified. Is it a cash flow hedge, fair value hedge, or hedge of net investment foreign operations? But in general, as I mentioned here, that it is classified and measured at FVTPL. Let us understand about the embedded derivative. So when I just talk about derivative, I mentioned that derivative is what? Is a contract or financial instrument with a contract which where the value is changed based on the value of other underlying. Now the underlying can be interest rate, it can be foreign exchange rate, it can be commodity price, it can be index of prices, or it can be credit rating or other variables. So derivatives can have underlying from different variations possible. Now, when you talk about embedded derivative, the word embedded, it means a derivative contract, as we discussed earlier, a derivative contract which is embedded in the main contract, or which is part of a contract. So embedded means a derivative which is a part of contract. So there are two contracts. One is host contract and second is derivative contract. Wherever the derivative contract is covered as a part of the main contract, then it's called embedded derivative. Now, why in that case it is complex and difficult to understand about accounting? Because we have a two contract combined together in one. Here you can just look at and refer to Index 32, where we discuss about, there is also a discussion about the compound financial instruments. Same way here in embedded derivative, there's a one instrument which includes two contracts. One is the host contract, and second is the contract where the derivative is like is a part of the contract. Let us see one example to understand this embedded derivative. Optionally convertible debenture. So optionally convertible debenture means what? The debenture is a bond. The bond is a one contract where I have borrowed money, which I have to repay back to the person from which I have borrowed the money. So there is one contract which is host contract, wherein I have borrowed money which I need to repay, and also I have to pay interest on that. That is one main contract. Second is option convertible, where there is an option given to the instrument holder that it can be converted into equity shares. So convertible debenture is one of the very important example where we can say it is a part of things. Now, the accounting, whether we do separate or not separate. Why this particular point come to my mind, that where I have one contract includes another contract, so it's a hybrid contract. So where there's a hybrid contract, then I have a question that am I required to separate derivative which is the part of main contract from this hybrid contract? So for that, the guidance is provided in Ind AS 109. Ind AS 109 says that if the host is not a financial asset, Ind AS 109 provide you with the definition of what is a financial asset, what is financial liability. Now, if the host is not a financial asset, so the main contract in which a derivative is embedded, if that is not a financial asset, in that case, you have to separate if and only if first. So there are 3 points. First, economic characteristics of and risk are not closely related. Means that the derivative instrument and the main host contract, the economic characteristics of the both contracts, the risk of the both contracts are not closely related. There is no science of looking at to this particular point why they both are being combined together. They are combined together, but unable to understand the sense of coming together because the economic characteristics and risk are separate for both of these things. Let us take one example to understand. For example, a bond linked to the price of gold. That means a bond wherein basically a price to gold means basically a bond where one contract is where I have to redeem or I have to repay. That is one contract. A second is price of gold. So wherein the amount to be payable of interest is based on the variation in gold price. So for example, I have to repay the bond. How much interest to be payable? That is being linked with the increase in the gold rate. So these both are something which are, there's no economic characteristics of both are connected. Gold is a different class of asset and the bond is different class of assets. So combining these both together is called something where economic characteristics and risk are not closely related. Separate instrument which will meet definition of derivative means I can separate only first the economic characteristics risk are not closely related. Second, separate only if the derivative, it meets the definition of derivative. So for example, gold, the example which I provide you, but the price of gold. So if it is derived, the value is derived from price of gold, and if that is separately also being qualified to be the definition of derivative, then only we can think of separation. And third very important thing is hybrid contract as a whole is not measured at FVTPL. Obviously, where separation of the derivative from the hybrid contract is difficult, you can measure the whole contract at FVTPL. So if these three conditions are fulfilled, you can separate the host and derivative contract from the hybrid contract. However, if that is not the case, where the host is a financial asset or it is not fulfilling the definition of these three conditions, in that case, designate the entire instrument at FVTPL. So when I just mentioned FVTPL, it means a fair value through P&L account. That means change in fair value of the whole entire contract will be taken to profit and loss, right? So fair value to P&L account, the change in fair value of the entire contract. When I look at entire contract, means I'm not required to look at what is the fair value change of derivative, what is the fair value change of host contract, because the entire contract fair value change is taken to profit loss statement. Now with this, we need to also look at the basic terminology of sometimes the word which has been used in common parlance about hedging and hedge accounting. I think these both are the different words. When you use the word hedging, doesn't mean hedge accounting is there. Hedging is where you want to manage the risk by using a financial instrument purposely to offset the variability in fair value or cash flow of a recognized asset or liability, firm commitment or future cash flow. So the word when hedge come into picture, I think we are talking about managing risk. As I started my session, I mentioned that the derivative instrument is one of the risk management strategy which has been taken by a lot of corporates. So when you mention about hedging, the purpose is to talk about managing risk by using financial instruments, by using hedging instrument purposely to offset. So what you want to manage the risk of change in fair value, the risk of change in cash flow, the risk of the change in cash flow or fair value because of firm commitment or future cash flow items. So that is the hedging. Now we need to also look at, there are three very important terms. One is hedge item, second is hedging instrument, and third is hedging effectiveness. Hedge item is the risk which is hedged. For example, if I have taken a foreign currency borrowing, so 500 billion of the loan I have taken, which is in USD. Now, what is risk to me? Today, the exchange rate is 86 rupees. Tomorrow, it can be 90, 100, or it can be 80 also. So, I have a risk that my outgo may be different than what I can foresee today. So hedge item is what? The hedge item is the foreign currency borrowing. Now to hedge that foreign currency borrowing, I have entered into a contract with a bank where they want to give me or where I want to ensure that I also received or my foreign currency has been pegged at 85 rupees. So instead of fluctuation at 86, 80, 70, 85, 90, I entered into contract with the bank that to match with this particular borrowing repayment, I convert my foreign exchange rate and make it fixed exchange rate at 85 rupees. So the contract enter into the bank wherein my foreign currency risk has been pegged at 85 rupees is called hedging instrument. So the hedge item which has been defined here under standard Ind AS 109, it is an asset or liability or firm commitment or highly probable forecast transactions or net investment in foreign operations. That then there are two conditions, two criteria. First, that exposes the entity to risk of change in fair value or cash flow. So hedge item exposes the entity to risk of changes in fair value cash flow. and is designated as being hedged. That is the definition of hedge item. Second, hedging instrument, we discuss the instrument which has been taken to offset that particular risk. And hedging effectiveness. Now, what is relevant, you will discuss, you will understand more when we talk about the cash flow hedge, when we talk about hedge effectiveness. So hedge effectiveness is something where the instrument which hedging instrument which I have entered into, it is effective in offsetting the risk which has been generated from hedge item. So if the hedge instrument is not effective, I think they both are a different instrument. It may not qualify to be part of hedging. So for hedging, the most important thing, the instrument which has been taken is able to offset the risk which has been arising from the change in the value of the hedge item. So hedge instrument effectiveness as it is defined as a degree to which change in fair value or change in cash flow of hedge item is offset by change in fair value of cash flow of hedging instrument. So I have two things. One is hedge item, second is hedging instrument. For example, the change in fair value of hedge item where hedge item fair value is reduced, hedging instrument fair value increases. They both offset. That is very effective. Hedge item cash flow, the change in hedge item cash flow result into increase in more cash payout. Hedging instrument should result into receipt of more cash. So then they both will offset. So the hedge effectiveness is where there is a hedging instrument which offset whatever change happens, whatever risk happens due to hedging item. That is a very critical for all of us to understand how whether to do hedge accounting or not. So the very important part under hedge accounting is that we need to ensure there is a formal designation. If you want to do hedge accounting, first you have to fulfill, and there's no documentation available which suggests that the derivative instrument which I enter into, it is qualified to be hedge. All derivative instrument doesn't qualify to be hedge. To ensure and do accounting of hedge, but is to ensure that the derivative instrument which has entered into it qualifies to be a hedge. Now, how can I demonstrate? I can demonstrate based on these things where the increase in fair value, reduction in fair value here, increase in cash flow payout, reduction in cash flow payout, they both offset. That is where now how it can happen. For that, practically we need to look at the instrument, that is hedge item and hedging instrument, whether both lacks of making payment, timelines, the amount, everything, is it back to back or not? If the hedging instrument terms which are critical, which are back to back of hedge item, then this is maybe effectiveness. But how does it need to have a formal designation and documentation to have hedge accounting? Only eligible hedging instrument hedge items are qualifying. Economic relationship between hedge items and hedging instruments giving rise to offset effect of credit risk. Hedge ratio need to be seen, which is result from quantity of items hedged and hedging items used to hedge. So they, how this has been changed. So one is the effective where the hedge ratio is that it is equally changed. And we also need to look at rebalancing of 50 days. If there is some change in economic relationship, if there is a change in risk management hedge ratio, then again you need to reassess that whether the hedge is still qualified to be hedging or not as per Ind AS 109. Now let us look at the accounting for hedging. There are three different parts of the hedge. Can be of cash flow hedge, or it can be a fair value hedge, or it can be hedge of net investment. It is called cash flow hedge. The word cash flow hedge, it already means that you want to hedge what? Exposure to cash flow variability. I think the word itself is able to give you a very, very important things that you intend to hedge the exposure to cash flow variability. That is a part of the cash flow hedge. In fair value hedge, you intend to hedge of exposure to fair value variability in assets, liability. or unrisked firm commitment. And in case of hedge of net investment, you want to hedge the entity's interest in the net assets of foreign operations. So these are the main three way the hedging has been divided. One is the cash flow hedge, second is fair value hedge, third is hedge of net investment. As far as account is concerned, all derivatives and to be classified and measured at FATPL unless hedge relationship meets qualifying criteria. So what we discussed in earlier slide, we discussed about the earlier two slides where we talk about how to evaluate whether the hedging is being met or not. For that, one need to study and review the derivative instrument and also hedge item. Whether the derivative instrument and hedge item they both are correlated with each other, whether the hedge is effective. If that is being qualified, measured, and documented, then only you can talk about hedging. If so, then in general, in case of cash flow hedge, this is a cash flow hedge we talk about, where the object is to hedge exposure to cash flow variability. In case of cash flow hedge, fair value of hedging instrument. So if I've taken a forward contract, right? So change in fair value of forward contract is to be taken in cash flow hedge reserve in OCI. However, if the hedge is ineffective or the some portion of the hedge is ineffective, the ineffective portion need to be reclassified to profit and loss statement. So this is primarily mainly focusing on the accounting of the hedging. Except the cash flow hedge, every change in fair value hedge need to be taken as a part of the profit loss statement. Let us look at a few examples to understand that is it a cash flow hedge, fair value hedge, whether it will be taken to be part of profit loss statement or it will be part of other comprehensive income. One example which is very common is that exporter is exporting out of India. The receivables are in foreign currency. So the exporter is going to receive from the customer the amount in foreign currency, for example, USD. Now the risk is what? The what way is exchange rate when it receives the money is not certain. So to offset that risk, the exporter entered a forward contract wherein it entered into contract to pay USD. Why pay USD? Because it's going to receive USD from customer. So pay USD and receive the fixed amount. So the derivative contract when they enter into contract rate was 60 rupees. On balance sheet date, the contract rate becomes a 62 rupees. So that means I'm just talking about the fair value of derivative. So when the company entered into forward contract, the rate was 60 rupees. As on the reporting date, the rate for similar contract comes to 62 rupees. So there is an increase of 2 rupees, but however that 2 rupees increase will mean there is a loss for a notional loss of 2 for the purpose of the exporter, and that will be the part of profit and loss statement derivative. Now, as far as hedge account is concerned, so for derivative gain or loss, it is part of hedge P&L account. As far as hedge account is concerned, it is qualified as a cash flow hedge. So, and if it's effective, it is a part of OCI. Why? Because the purpose is to offset cash flow. By cash flow, I have a foreign receivables. I'm going to receive cash from my customers, and I want to hedge that cash. So what I'm hedging the fluctuation in the amount to be received as cash flow hedge. If it is effective, it will be part of my OCI. Second example, borrower. I have a foreign currency borrowing with me, and the interest which I have not foreign. Let us assume here it is IRS swap. So in swap, we are talking about where I have a loan. It can be my functional currency Indian rupee. However, the interest rate to be payable is a floating interest rate. Floating is a LIBOR plus or some other benchmark plus rate is there. So what is my risk? My risk is that that amount of interest to be paid is a floating. So I don't know the what will be interest cost tomorrow at the LIBOR or some benchmark rate in plus or minus. My interest cost will go up or down. So here what happens that when I enter into contract, it was 10%. On balance sheet rate, interest rate increased to 11%. So 1% notional gain. So it will go, the derivative will always go to P&L account. And hedge accounting is a cash flow hedge, because what I want to offset, my intention is to offset cash flow, because today my cash payout is not fixed. As interest rate is a floating interest rate, my cash payout is not fixed. I want to fix that particular risk. I enter to contract. Once I enter to contract of IRS interest rate swap, my interest rate change from floating to fixed rate. So I'm hedging cash flow. If it is effective cash flow hedge, it is part of my OCI. I'm borrower, again here interest rate swap is there, but I am changing fixed to floating. Now question may come in mind, why would you change from fixed to floating? However, where the borrower believes that they want to have the liability near to the market, so they want to have the asset liability near to market, that's fair value. So instead of fixing that cash outflow, they want it to be floating. So it is called fair value hedge, and here it is part of P&L account. If I'm a manufacturer where I'm entered to copper future, where I'm hedging raw material cost of forecasted transaction, where I intend to contract with a supplier that I will buy a copper, and this is a forecasted transaction. I just want to hedge the movement in the copper price. So then again, it will qualify to be a cash flow hedge, because I'm trying to hedge my cash payout to a supplier. So that's why it is part of cash flow hedge. Let us take a few examples to understand this fair value and cash flow hedge. On 1st January, entity A issues rupees 10 lakh of fixed rate bond with a coupon rate of 5% per annum, paid annually in arrears on 31st December. The prevailing market interest rate for similar bonds rises, and by 30th June, the fair value of bond has decreased to rupees 980,000 due to this interest rate increase. So what happens that the it is a fixed rate with a 5% rate, the market rate has increased. So what fair value of bond has reduced. Entity A enters into interest rate swap to hedge fair value exposure. So my interest rate payout is a fixed, but I'm concerned about my valuation in my books of account. So I say I don't want to have my interest rate to fix. I want that it should be whatever market is, that it should be my interest rate. So I intend to IRS interest swap, where I convert from fixed to floating. So the swap has a national principal of 10 lakhs, matures on the same day as the bonds, and involves entity receiving a fixed rate of 5% and paying a floating rate. So I receive fixed 5%, I pay floating to for derivative instrument, then I pay fixed. So that is my if you just look at net position is such where I am paying a floating rate. So my liability risk has been reduced from change from fixed to floating, and the fair value of IRS on 30th June is 20,000 as an asset. So first very important thing is a fair value hedge, because I am hedging the fair value change in fair value of the derivative instrument. The hedge item recognition of fair value changes in P&L account is 30,000 rupees, because hedge item, there is a change in hedge item, and second derivative instrument, again it is offsets equally. Practically it may not be equal, there can be a plus or minus here. However, the purpose here is to look at is a fair value hedge, change in hedge item and change in his hedging instrument, the both will go to profit loss statement. Second is the cash flow hedge. Here entity B borrows 500,000 at a floating rate. So floating rate is LIBOR plus 1%. I am changing interest rate floating to fixed interest rate. So what will happen here is that I'm trying to hedge my cash flow risk. So it is a cash flow hedge. The swap has a notional principal of 500,000, mature on the same day as the loan. Involve entity B paying a fixed rate of 4% and receiving floating interest at a LIBOR. By December due to change in the expenditure rate, the fair value of IRS has increased to 15,000 rupees. So what happens? The fair value of swap derivative instrument has increased to 15,000 rupees. and cumulative change in present value of expected future cash flow of hedge item is decrease of rupees 14,000. So in this case, it is called cash flow hedge, right? One very important thing. Second is you to recognize interest expenditure, which is your actual interest expenditure, and derivative instrument wherein you recognize a change in fair value in OCI because it is cash flow hedge. But however, 15,000 rupees is my change in fair value, but 1,000 is ineffective. If so, that ineffective portion will be reclassified to P&L account. As I discussed that in case of cash flow hedge, the change in fair value will be part of OCI. If it is ineffective portion, that ineffective portion will be reclassified from OCI to PL account. Now, the last very important point is on IndusInd Bank, friends. So we discuss about the. So you may have question or you may have thought that why so big bang still there is an issue in this. Friends, I think it's really complex. Even though we understood the concept one to one, when talking about the like thousands of contracts, different maturity, and there are different derivative instruments, then it is really difficult to understand that how they both offset each other. What happens that on 10th March, the internal review of derivative portfolio had revealed a potential 2.35% of adverse impact on net worth. So last year there has been going on internal review and assessment, and on 10th March they declared announced publicly that there is some potential adverse impact. They 2.35% of net worth can be impacted, which can be approximately 2,100 crore rupees on the bank. As per directives on investment issued by RBI on September 23, the banks are prohibited from conducting internal trades or hedging, and accordingly, IndusInd Bank ceased internal trade from April 1, 2024. So one very important thing is that actually in bank, when you look at, I think it is a very complex way the derivative has been because there are different departments. One is internal trade, second is external. Internal trade has a huge team which does day in day out of these particular things, and there are external like department is there which talks about how to do hedging of these things. They both sometimes don't talk with each other. They have their own accounting policy, they have own policy, and that they do it on their basis. And if they are working on silos, then this kind of things can happen in the picture. So internal trade having low liquidity instruments 3 to 6 years yen borrowings and 8 to 10 years of dollar borrowings, hedging through internal trading desk instead of external counterparts. So there are internal desks which are having low liquidity, means medium to large term instruments are there, and these borrowings were being hedged through the internal trading desk. They are not approaching external counterparties, but they hedge internally. So there's an internal trade which was doing it, and derivatives are used by treasury departments. So there are two departments. One is internal trade, second is treasury department. Internal trade does themselves, and they do by their internal trading desk, and treasury department was there to talk about with external commercial party for doing derivative accounting. So there are divergent valuations. External trade valued at MTM, internal trade was valued on a swap valuation. So what happened here is that internal trade valued a swap and external trade valued MTM. Now they need to basically come to a situation where when we discuss about a case where they both if reconcile with each other, one increase, second decrease should offset each other. But however, when the both are not synced together, probably they may not be able to basically come together on during the contract period. However, on a they will align at only at maturity. So that is what is available on in media, and I'm just giving you briefing about what has been available in media. But right now, the company has appointed a forensic like expert who is going to go into detail to identify why these lapses happen, what is the quantum, the year in which it happens, how it can be rectified, and these all the questions are still unanswered, and then we may have to basically wait for a little more time to understand. So friends, before we end, this is the last slide, we are just going to focus about the Ind AS 109 compared to AS. Under accounting standard, AS 11 is there. If you just look at the only standards, only AS 11 is about foreign exchange, and that talks about a foreign contract. There's no standard which talks about conclusively on financial instrument and accounting standards. So there is an ICA guidance note on accounting for derivative. So we one has, if questions about derivative accounting under accounting standards, one is to refer to AS 11 and ICA guidance note on derivative accounting. AS 11 talks about the related foreign exchange. So forward contract, future contract related to foreign exchange are counted AS 11. Under the accounting for guidance, derivative guidance note, it talks about everything else other than what is counted AS 11. Under India's 1019, it's a very comprehensive, which takes care of all kind of situations. Under AS 11, there is also discussion about the treatment of forward premium and option over the period of time. Under India's 109, that is not something which is being allowed. It is a fair value is what has been taken as the one of the most important measurement, then it is taken as a FTPL, or if it is hedging, part of cash flow, part of OCI. Cash flow hedge accounting treatment under ES 11 ICRS note, cash flow hedge reserve is part of equity, because there is no OCI in accounting standards. There is no OCI in non-India's companies. Under India's, it is a part of OCI and also component of equity as far as India is concerned. Embedded derivatives, as we discussed about, where there is two contracts as a part of one contract, hybrid contract, it is not a part of the scope as far as the account standard is concerned. But in India's, there is a guidance is provided about how to identify, where to identify, how to separate it. The disclosure which are provided in 109 are much more extensive as per these things. So with these friends, I think the most important thing is that the purpose of today's webinar is to highlight and touch upon one of the most crucial in today's scenario, because we all have been skeptical about the derivative accounting, because for a large companies, financial institutions, I think this is something which is very very big, but somehow how much you're confident, how much the company management is confident, how much the auditors are confident is a question, and probably we will get more idea once we get the forensic accounting report is out. So derivative accounting is not just a technical, it is a strategic. The recent development shows how even a lapse in derivative accounting can make a huge impact on the company's valuation also. So with these friends, I stop here and wait for any question which you are having, and we can have a discussion on this. What was the rationale behind? I think Vijaya has asked question. What was the rationale behind RBI saying banks are prohibited from doing inter trades or hedging? Vijaya, I think these for that we may have to refer to a lot of board meetings discussion on that. As far as my understanding is concerned, in my view, the RBI also is able to identify during their audits that this is something which is not giving a fair picture, because RBI conducts audit regularly of bank, and during that inspection they there are a lot of observation has been received wherein they highlighted that this kind of strategy is not correct in a good habit. So probably this may be the cursor which has come out with this particular induced in the bank's exposure of derivative has really been big thing for all of us to understand. Any other questions, friends? I understand this is just a starting point. A lot of things which we need to do, and I hope that this webinar will be helpful to you to have the basic overview and understanding of the derivative accounting, importance of hedging accounting, hedge instruments, and then I think if any questions, I will be definitely be there to answer. I will share my presentation to Taxmann, then they will further forward to you all of you, and then you can also be in touch with me. My contact information are available in the presentation for your reference. With this, I hand over the charge to Taxmann team for taking it further.
Thank you, sir. Thank you so much for enriching our understanding with your insightful presentation. We greatly appreciate your effort in making this session a success. I would also like to thank all the participants for their time and cooperation. Your engagement is invaluable. While we endeavor to address all queries during the session, please do not hesitate to send any additional queries or feedback to connect@taxmann.com. But sir, before we conclude, I think there is someone want to ask some question, I guess. Mr. Kamal has raised his hand. Can we attend him, sir? Chintan, sir, you are on mute.
Oh, yeah, Kamal. So I just you were mentioning here the written options. So can you elaborate further more on what do you mean by written option and what is your question? Kamal, you can also unmute and speak, or you can also write in your chat box about your elaboration of question.
Hello?
Kamal, you.
Yes, Kamal, please.
Yeah. So am I audible, sir? Right
yes,
now?
you're audible, please. Go.
Yeah. So, sir, as you know, we have different option strategies in market.
Hmm.
So, as hedging strategies, we are using zero cost option in our company.
Hmm.
So, I read in somewhere in the Ind AS 109 in the bare text. So, it is said that if we have written an option, then it is not treated as the hedge accounting. It will not be treated as a hedging relationship. So can you elaborate how to account for the hedging on the zero cost option or some option which include written options? Like we because we are exporters, so what we do, we buy put and sell the coal. So it includes a hedging which includes the written option. So how to account this? I have that question, sir.
Yeah, so Kamal, can you just give me more information about in zero cost option? I think is it like interlinked or matched with your export receivable?
It is matched with our export receivables.
Okay, so the timing of the export receivable, the amount, and everything is being matched with that.
No, sir. It is not matched.
Yeah, so that is the reason why, because for qualifying hedging, I think we need to look at hedge documentation, and we need to first look at that whether the both are in sync or not. Because as we mentioned, change in value of one should result into the reciprocal change in the value of other item. Then they should be offset, and only if it's effectiveness, then only we can discuss about more on is it cash flow or not. Because now, Kamal, let us understand that, for example, if it is not qualifying hedge, frankly speaking, practically, I have seen in my lot of client cases that if it doesn't qualify for cash flow hedge, then it's good for you to do accounting, fair value hedge accounting, or you can do accounting, because if it's a cash flow hedge, if it does qualify as hedge accounting, then your account is more simpler. You take the change in fair value of the hedging instrument and change of fair value of hedging item both in P&L account. So in my view, they both will be able to offset very easily compared to if you take in cash flow and then you classify two P&L account.
Okay. So, but right now we are taking it in OCI. I am in not in the financial accounting department. I am in a treasury, but I have seen that they are taking it in OCI. So I raised the question by why you are not, there is no hedge effectiveness. Then why are you taking it in OCI? But they are not able to answer. So that's why I'm raised that question. But it should be a part of OCI or should it be a part of P&L?
Yeah, so in my view, as I understand, discuss with you at this juncture, it seems that it should be not, it should be part of OCI. But however, I think if they have taken audit call, there may be some kind of documentation available which suggests that it should be part of OCI. So probably you can have more discussion on that. And if you want to have a further understanding with me, you can just you can also reach to me. I will share my mobile number also or email it to you on this.
Sure, sir.
And
It
then
would
we
be
can.
more beneficial. Sure, sir.
Okay. Thank you,
Okay.
Kamal.
Thank you.
Sir, we also have Miss Aarti Bali.
Uh, who is there?
Sir, good evening.
Yeah, okay. Good
Hi,
evening,
my
Aarti.
name is Aarti. Yeah, so I just have one query on the foreign currency exposure certificates which the chartered accountants are required to issue in case of exporters
Hmm.
to the bankers. That's required by the bankers. So here,
Correct.
what the certificate requires us to say that all the derivative contracts considered as hedging contracts are in conformity with the pronouncement of ICAI in
Hmm.
respect of their hedge effectiveness
Correct.
vis-a-vis the underlying exposure. So, can you throw some light on this? Like, what exactly is the chartered accountant supposed to verify in connection with the hedge effectiveness for this?
Sure. I think it's really Aarti is really very good question
Yes.
because I have seen practically lot of banks are pushing us and client push us saying
Yes.
that you just give certificate and then we do just provide. I think they use the word just. So just means it is like something just signing it, but I think it is huge responsibility on our shoulder.
Right.
So first and foremost, which we need to understand, and you can also look at my presentation once it is shared to you, is about the hedging and derivative account is different thing.
Mhm.
Derivative accounting is where you enter into a contract so that your objective is to hedge. It may not qualify to be hedging. So to be hedging, the most important thing is that the both contracts should be in sync. I think everybody we feel that I have entered for a contract. My overall purpose may be to hedge, but doesn't mean that it is qualified for hedge effectiveness. You can also refer to the ICA guidance note in April 2021 detail which ICA has issued. I will also share here in the link to here where it explains effectiveness. Now to give you a brief practical understanding about how you can check as a CA, first very important thing is that look at the derivative instrument, look at the terms of derivative instrument, what's the amount of forward contract when it's entered into, what is the amount entered into, and what is the period. Look at the hedge item and whether the hedge item and hedging instrument they both correlate with each other, or whether whenever the hedge item is whether I'm going to get export receivable, whether the hedge instrument is such where that I am going to get the foreign currency from the bank on the same period when I'm going to get a receivable. So objective of effectiveness is in general is means what, that the instrument which I enter into, it is not only a derivative instrument, but it also is able to offset the the risk which is arising from hedge item effectively. For that there are a lot of conditions are being narrated in this guidance. I will just search right away and I will share you the ICI guidance note, probably which will be helpful to you. I hope Aarti I'm able to give brief idea. Probably it may not be possible to give you detail, but I think you will be able to get the understanding of what I'm trying to say.
Yes, yes. Thank you. Thank you so
Yeah,
much.
welcome. I have shared the link of ICA guidance note on derivative accounting. I think this will be able to provide you more idea on this thing. Yeah, friends, if there is no questions,